Take two guys, both 27, both earning around $58,000 a year. In March of 2009, they each opened a brokerage account for the first time, starting with $5,000 they'd managed to save. They were starting at a point of absolute carnage. The market had collapsed by 57%, unemployment was nearing 10%, and the news cycle was a constant loop of bank failures and economic disaster. Guy number one saw the chaos and concluded that staying in the market was insane. He moved everything to cash, intending to wait for things to stabilize before jumping back in. Guy number two did the opposite, keeping his regular $500 monthly investment going, gritting his teeth to buy more when headlines got worse. 11 years later, guy number one had roughly $18,000. Guy number two had over $210,000. The divergence in their wealth wasn't a matter of intelligence. It was dictated entirely by how they behaved during a specific 3-month window of global panic. Based on the current surge in market volatility and consumer dread, we have entered another one of these rare behavioral windows. This gauge tracks the CNN Fear and Greed Index, currently in the extreme fear zone. Readings this low appear on just 3.4% of trading days, a direct response to oil supply shocks and a rapidly doubling VIX index. The financial media is responding with its standard playbook, amplifying the catastrophe, questioning the viability of growth stocks, and urging viewers to rotate into safe havens like gold. For most people, the urge to pull back feels like common sense. The headlines make the short-term risk feel so overwhelming that acting like guy number one, moving to the sidelines, seems like the only responsible move. The panic runs on a specific logic called the fear chain. It starts with an oil spike, raises shipping and manufacturing costs, leading to higher inflation. That inflation then forces the Fed to keep interest rates high, which eventually chokes off economic growth. This isn't just abstract theory for a family spending 35% more at the pump this month. For them, every single headline about $120 a barrel oil represents a very real threat to their monthly budget. This chain points toward the ultimate economic nightmare, the stagflation of the 1970s. That decade was defined by 14% inflation and the kind of severe fuel rationing seen on signs like this one. However, the structural conditions today are completely different. In 1974, the U.S. was a net importer of oil, and GDP was contracting. Today, the U.S. is one of the world's top oil producers, and productivity is actually surging at over 4% annually due to widespread AI adoption. We are seeing the same symptoms of inflation, but the underlying economy is far more resilient than it was 50 years ago. Treating the current volatility like a 1970s collapse is a misdiagnosis of the data. When you look at the 100-year ledger, the pattern becomes clear. RBC Wealth Management analyzed 20 major military conflicts since 1950, from the Gulf War to the invasion of Ukraine. On average, the S&P 500 bottomed just 13 trading days after the start of those conflicts and fully recovered within 28 days. The entire life cycle of the shock, from the initial crash to a full rebound, typically lasts less than 6 weeks. Historically, markets are surprisingly resilient to geopolitical violence. The Dow gained 29% in the year following the invasion of Kuwait, and even during World War II, the market rose 50% between 1939 and 1945. The ultimate proof is in the rolling 20-year returns. Look closely. In every recorded 20-year period in U.S. history, periods that included world wars, severe economic depressions, and global oil embargoes, the stock market has never once delivered a negative return. The American economy has the scale to absorb almost any shock that doesn't halt its core functioning. Because a 20-year holding period has a 100% success rate, staying invested isn't a gamble. It's the only mathematically sound strategy. Current market panics aren't a signal to run. They are temporary pricing errors where the stress on these faces overrides actual company value. Look back at March 2009. While the headlines were predicting a total collapse, guy number two was consistently putting $500 a month into Amazon. By the end of the decade, his total investment of $60,000 had ballooned into roughly $2.3 million. The same window created massive multipliers for other tech leaders. Microsoft delivered a 25 times return, while Apple saw a 90 times increase from its 2009 low. These were the world's most dominant cash-generating businesses, trading at deep discounts simply because investors let the news cycle dictate their math. We are seeing a similar pattern of sentiment-driven selling today. Microsoft has seen a 20% drop this year, with Amazon and Meta also trading at significant double-digit discounts from their recent highs. These massive companies hold structural advantages in cloud computing and global logistics that have taken decades to build. Their current prices are being driven down by short-term fear, not by a change in their long-term ability to generate profit. The most expensive mistake an investor can make is selling when the crowd panics. We saw it during the COVID crash of March 2020, when millions moved to cash right before one of the fastest rallies in history. To end up with guy number two's results 10 years from now, you have to override your emotional response today. Put your gut feelings aside, look at the historical ledger, and keep buying the discount. Right now, watching red numbers scroll across your screen, your brain is specifically wired to drive you toward cash and certainty. Daniel Kahneman and Amos Tversky established through decades of research that losing a dollar feels roughly twice as painful as gaining a dollar feels good. Evolutionary wiring prioritizes survival over portfolio growth. The humans who survived were the ones who strongly avoided losses, and that biological hardware is currently reacting to the fear in the headlines. The research firm Dalbar has tracked the actual cost of this instinct for 30 years, measuring the gap between what the market returns and what the average investor captures. The S&P 500 returned 10.35% annually between 1985 and 2015, while the average investor captured just 3.66%, a gap of 6.69 percentage points every year. Compounded over 3 decades, this underperformance significantly alters a retirement portfolio. Dalbar's data suggests that for retail investors, selling during periods of extreme fear is a primary driver of long-term wealth destruction. Investors today face 3 options. The first is selling to wait for a sense of safety, which typically means buying back in at higher prices after the recovery is already underway. This line graph shows the mathematical penalty of missing the market's best days. Over 20 years, $10,000 grew to over $64,000. Missing just the 10 best trading days leaves you with less than half that amount. JP Morgan data shows that 76% of the best trading days happen during bear markets or the first 2 months of a new bull market. The second option is to do nothing. Holding what you have prevents locking in losses, but it fails to capture the compounding advantage of buying at a discount. Waiting for a signal that the market is safe guarantees that an investor will miss the days that build the majority of their long-term wealth. The third option involves maintaining a regular investment schedule into broad market S&P 500 ETFs and quality companies with durable business models. Prices for dominant market leaders often drop due to fear rather than a change in fundamentals, creating a window to acquire ownership at a fair discount. The math of investing during a downturn is efficient. This equation shows when the market drops 30%, a standard monthly investment buys 43% more shares. At a 40% drop, that same dollar yields 67% more shares. These conditions facilitate the accumulation of ownership in high-quality businesses, while their valuation is temporarily disconnected from their earnings. Consider 2 investors in March 2009. They have identical salaries and identical capital, but they are processing the same terrifying headlines in 2 different ways. One moves his $5,000 to cash. He views this as a protective measure to be reversed once the news cycle improves. The other keeps investing. He understands that the safe signal he's waiting for will only arrive after the recovery has already started. This charts the 2009 recovery. The market bottomed March 9th. By June, when headlines confirmed recovery, the S&P had already surged 40%. A decade later, the consistent investor grew to $210,000. The cautious investor held $18,000. Generational buying windows are brief, and they usually vanish the moment a majority of people believe the recovery is coming. Current global instability often creates a distinction between international chaos and domestic market performance. During periods of severe geopolitical tension, such as the invasion of Ukraine, global capital markets experience immediate volatility. Historically, institutional money from around the world flows into US dollar-denominated assets during these crises. This behavior caused the US dollar index to surge 9% during COVID, and nearly 12% during the Ukraine invasion. The $24 trillion U.S. Treasury market remains the deepest, most liquid financial market on Earth, acting as a primary destination for global capital when conditions destabilize. Building wealth requires acting on structural data, even when your nervous system is reacting to headlines. The window is currently open. What happens next depends on your ability to look past the fear.